Hello guys, welcome back to Study FX channel. On this channel, it's all about forex trading, binary trading, and crypto trading. So if you're new here, welcome, and if you're a returning subscriber, thank you for always coming back to watch my video. So this is a part 3 or a continuation of forex trading. So make sure you watch until the end. The topics that we are going to cover on this video is what is a forex quote, bid and ask prices explained, what is a spread, why bid and ask spreads matter, factors affecting the spread, and also the tips for traders. Or the first thing that we need to know here is what is a forex quote. A forex quote shows the price of one currency in relation to another. This is essential in forex trading because currency are always traded in pairs. For example, we have euro USD. So the first currency is euro, which is the base currency, and the second currency is US dollar, which is the quote currency. So in this case, let's say euro US dollar equals 1.2150. It means that 1 euro is worth 1.2150 US dollar. Always the base currency is equals to 1. Always note that. So the next thing that we need to know is about bid price and ask price. So the forex quote are always shown in two prices. This is the bid price and the ask price. So the first one that we are going to go through is the bid price. The bid price is the price at which the market or the broker is willing to buy the base currency, and I told you the base currency is equals to 1. So in this case it's euro. So in simple words, the bid price is the best price you can sell in the market. So if you want to sell a currency, the broker will buy it from you at the bid price. So I hope you get that. So example, if you see a quote, let's say euro USD equals 1.2150. the bid price is 1.2150. This means the broker is willing to buy 1 euro for 1.2150 US dollar. So the next thing that we need to learn here is the ask price. The ask price is the price at which the market or the broker is willing to sell the base currency. So the bid, it's for buying, and for ask price, it's for selling. So in simple terms, the ask price is the best price you can buy in the market. So sometimes people also ask the ask price as the offer price. So if you want to buy a currency, the broker will offer it to you at the ask price. Ask price is 1.2152. This means the broker is willing to sell 1 euro for 21.52 US dollar. The spread is the difference between the bid and ask price. It represents the cost of trading and is essentially how brokers make money. We are going to use our previous one, like 1.2150 and 1.2152. So we are going to take 1.2152 minus 1.2150, and it's going to be 0.002, which is equals to 2 pips. So in this case, the spread is 2 pips. So pips stands for percentage in profit. So let's say you wanted to enter the market at 2782.4. So when you click buy, the broker is going to at least it can draw you, let's say, 2 pips or 3 pips up. It really depends with the broker that you are going to use. So if you wanted to enter the market, unless you put limit order, sell order, like that, unless you put that, but if you are going to enter the market directly, let's say you wanted to enter at 2782, when you click buy, the broker is going to maybe take you to 27.85. So the difference of those pips, like 27.85 minus 27.82, it's around 0.003. So that is the spread, and that's how brokers make money. So I hope you get that. Also, I think when putting the stop loss, you have to at least calculate a few pips, so that to avoid the market taking you out, because the spread always counts. So why bid and ask price matters? The spread is crucial because it directly affects your trading costs. So tight spread. A lower spread means lower trading cost. This is common in liquid currency like Euro USD, there is gold, there is USD GPY, etc., etc. So a wide spread. A higher spread means higher cost. Like you're the one who is making a loss here, because the broker is making money. So this is common in less liquid or more volatile pairs like exotic currencies. So suppose you open a trade of Euro USD at an ask price of 21.62 and close it in a bid price of 21.60. Because of the two spreads, you need the market to move at least 2 pips in your favor just to break even. So the next thing that we can touch on is factors affecting the spread. So one thing that affects the spread is market liquidity. I think I have mentioned that, but let's just go through with it. Like pairs like Euro USD usually have low spreads. It's always between 1 to 2 pips, because they are highly traded in Forex. Next thing that affects the spread is market volatility. During volatile times, like during major news releases, spreads can widen due to increased uncertainty. So the next thing that affects the spread is time of the day. So during off market hours or low liquidity session, spread may also increase. Like let's say for New York, the market is so volatile, the liquidity is high. So the first thing that you need to do here is monitor the spread, aware of the spread when entering a trade, as it's a hidden cost. Always choose a good brokers. Some brokers offer tighter spreads, especially on major currency pairs. For me, I usually recommend, because that's what I use. I use FBS. Also, another tip for traders is avoid trading during news release. Spread can widen dramatically during news announcements, increasing your trading cost. Make sure guys you watch my future videos, because I'll drop a video about the news and how you can spot the news that are going to affect your trades, and the news that don't have any impact on the currency that you're trading or anything else. So guys, that is for today. See you in my next video, and I appreciate for you guys for coming back to watch my video, and I hope these videos are benefiting you and you are gaining knowledge from this, and I wish you all the best in your trades. Let's make money here. Yeah, bye.